Listen to me. Average returns on boring investments are the key for building your wealth. Hello, my favorite 10, 11 subscribers and everybody else who's watching this video. I'm back with another video about personal finance. In my last video, I've talked about all the different ways how the professional money managers in the professional finance industry are ripping you off, they're stealing your retirement, and today, building up on the previous video, we're going to be talking about the beauty of average. We're talking about average returns, average investments, and how great it is to be average in the finance world. I know you're gonna ask me, average? I don't want to be average. I want to be stellar. I want to be spectacular. I want to be above average.
I am so great.
But no, in the finance world, being average is the key to success. And let me explain what exactly I mean. Being average in the finance world and investment world is great. It means not being taken for a ride, not being charged enormous fees, not being promised some outlandish returns that nobody can keep up for 5 or 10 years. Being average is being consistent. And the way how to stay consistent is not by trying to outsmart everyone. And what's worse, trying to believe that someone can outsmart the market for you. It's important to trust your investment strategy and go for low-cost options that will not rip you off in the long run. The key to affordable investing that won't eat away half of your future retirement income is by investing in index funds and low expense ratio ETFs. Index funds or ETFs are financial securities that mimic the composition of certain benchmark and are using computer algorithms to buy and sell only the stocks or bonds to replicate a certain index. Take for example of some staple indexes like Dow Jones or S&P 500. Well, there are tens or even probably hundreds of ETFs that do exactly that, mimic the composition of these popular indices, and that let you invest in usually in the entire market with just one click of a button. So by buying an ETF that represents that S&P 500, you don't need to pick and choose individual stocks and make guesses on which stocks are gonna go up or down. You're buying pretty much the entire market, so you're making your bet about the entire market, whether it's gonna go up or down, and you're getting the diversification across multiple industries and hundreds of stocks right away with just buying one financial security. And what's more important, you're getting average market returns, which are wonderful. Average market returns are great. They're your bros. Now you probably cringe when I say that you should settle for average market returns. You probably cringe even more when I say that ETFs are your bros. But anyway, remember just for a second that 96% of active money managers, the people who manage the most popular mutual funds, do not outperform the market on 5 to 10 year basis. Then why would you expect that you would be able to outperform the market and get above average market returns? Come on, get back to earth. And there is nothing bad in an average market return. Just to remind you, over the last 30 years, those average returns adjusted for inflation were above 8%. So if you stick to your strategy, if you invest for 20 to 30 years, you'll be able to reap the rewards. You'll be able to see your net worth grow exponentially. And just to give you another reminder, over the last century, for any given 17 years, the stock market hasn't lost any money. And again, ETFs are your bros. ETFs are the best vehicle for getting those average market returns. With ETFs, it's so easy to set up a simple yet powerful and diversified portfolio. Big financial firms offer a variety of different ETFs that might suit anyone's needs. You can get any exposure you want. Stocks, bonds, developed market, emerging markets, big cap, small cap, growth, value, commodities. Anything you want for any risk tolerance level or any needs. So, and what's so wonderful about them is that there is no intermediate level involved of active money managers trying to make decisions, trying to outperform the market and constantly messing up your glorious average returns with their stupid decisions. And since there is no intermediate level, they can keep their expense ratio levels are so low. Just to give you an example what I mean by saying low expense ratios. Like for example, a Vanguard owned total stock market ETF with a ticker symbol VTI. It offers exposure to the entire stock market with an expense ratio of just 0.03%. Compare it to the ludicrous 1 to 3% expense ratio of an average actively managed mutual fund. And with the ETFs, unlike actively managed mutual funds, you don't have to worry about them being shut down less than 10 years from the inception date because of the horrendously bad underperforming results. So pretty much ETFs are as close as you can get to a true buy and hold portfolio, where if you just believe that the American economy is going to keep on growing, you can capture those average returns without the noise and the extra layer of active money managers who are just messing up your sweet average returns. You can capture them, you can grow your net worth, and you can retire comfortably. Cutting down costs to keep your investment free from this stupid, rotten fees is absolutely paramount. And I'm not some financial guru who has known how to do it his whole life. I'm learning and I'm making mistakes as we go, and I'm sharing my experience here with you guys. So I recently revisited my 401k account to check how much exactly I was paying in expense ratio fees on the target date fund where I invested all my money. Yeah, target date funds is those types of investments that get shoved in your face on all of the 401k accounts. They're marketed as a true set and forget type of investment where you can just make the investment and they will take care of rebalancing the portfolio the closer you get to your retirement target date. So they'll move it from more risky stocks into a more steady bond portfolio. And for doing that, they're charging you, of course, a slightly higher fee. And so I went into all the details and I saw that they're charging me around 0.38% in expense ratio fees, which is not too bad, but it's not stellar either. But then I started digging a little deeper. So this funds, it benchmarks itself against some obscure index that it feels like it was created for the sole purpose to make this fund where I'm investing to make it look good. But then it said that the secondary benchmark was S&P 500, and oh my god, did it underperform the S&P 500. On a 1-year basis, it underperformed it by 8%. On 5 and 10-year basis, it underperformed it on average by 5%. This is massive. This is just huge. This is thousands and thousands of dollars lost. And guess what? The amount of risk, the amount of volatility you're getting is pretty much the same. So the second point, I started digging deeper and I found almost identical target date fund on Fidelity's website for year 2055, but it's outside of the 401k program for any other investors who just want to invest their money on their own. And guess what? That fund has yielded higher returns than the fund where I'm investing in 401k, very comparable to S&P 500 returns, provided less of volatility, higher Sharpe ratio, and guess what? The expense ratio is 0.12%. It's 3 times less than what I was investing for. I was just ripped off. I didn't know what to say. I'm just gonna walk out. This was so ridiculous. I couldn't believe I got fooled so easily. Of course I pulled all of the money out of that sucker and put it in the most basic, passively managed ETF that just tracks the S&P 500 and charges me 0.04% in expense ratio. So I learned my lesson here. You can control only what you can control. You don't know which direction stock market will go tomorrow. You cannot consistently pick the winner stocks. But what you can do is that you can try to lower and cut down on your fees. Accept the average returns and get on with your life. You will do just great. I appreciate you watching this video. Thank you so much. Subscribe to this channel, leave a comment, like this video. I wish you the beautiful, wonderful average returns in your life. See you guys next week. Bye bye.